Every time you swipe your debit card, you're handing someone a direct line into the account where your income actually lands every single month, not a credit line someone else is extending to you, not a pending hold sitting on a bank's balance sheet. Your real money, the cash your Social Security check deposited, the funds your pension transferred, the balance your mortgage payment is scheduled to pull from in 9 days. When that account gets breached, the money doesn't wait around while someone investigates. It leaves first. Every automatic payment, every utility bill, every insurance premium keeps moving on its own schedule while your account sits at whatever number a criminal left behind. Most people hearing this hold on to one belief that makes them feel protected. My bank covers fraud. That belief is accurate as far as it goes. What it doesn't account for is the sequence. The money exits the moment the transaction posts. The protection process starts after. And between those two moments, your financial life does not stand still. My name is Mason Parker. For over a decade, I've studied retirement benefits, senior tax programs, and the financial rules that affect seniors every year. Today I'm covering a specific structural risk that hits retirees harder than anyone else, and a specific arrangement that removes it permanently with one phone call. Before we get into it, let me say something directly about why I cover topics like this one. The seniors who find this channel early use the information before a problem ever reaches them. The ones who find it late use it to recover from something that didn't have to happen. If you want to be in the first group, subscribe right now and turn on the bell. That's what this channel is here for. Now, 3 assumptions that make this risk feel smaller than it really is. All 3 are wrong, and all 3 are expensive to carry. Assumption 1. You check your account regularly so you'd spot fraud quickly. What you'll actually spot is the damage already done. A card number captured by a skimmer 3 weeks ago can generate a $2,400 withdrawal at 3 o'clock in the morning. On the exact date your mortgage is scheduled to clear. You find out at 9 o'clock when your phone rings because the mortgage was returned. By then, the money's been gone for 6 hours. Assumption 2. Bank fraud protection means you're made whole immediately. Your bank has a process. What your bank doesn't have is a legal obligation to restore your funds while that process runs. There's a specific federal law governing exactly how long they can take, and most seniors have never read it. Assumption 3. This risk belongs to people who shop carelessly online. Over 243,000 debit cards were compromised by skimming in a single recent year. Skimming, by definition, is a physical attack at locations you visit in person and trust completely. Stay with me through this whole video because I'm going to show you the exact legal difference between the protection printed on your debit card by your bank and the protection actually written into federal law by Congress. Those are 2 completely different things, and that difference is what determines whether you're made whole or left waiting while your bills keep processing. The phone call that permanently fixes this is coming at the end. Here's something your bank has a structural reason to never tell you. Every debit card transaction generates revenue for your bank from the merchant. The more transactions, the more revenue. In 2026, Congress voted to roll back rules that would have capped overdraft fees at $5. Americans paid more than $12 billion in overdraft and return payment fees the year before that. The institutions collecting those fees profit directly from the same payment method they have zero incentive to warn you about. The branch representative who's known you by name for years has no financial reason to sit across the desk and tell you that the card you use most often carries the weakest legal protections of any payment instrument in your wallet and the highest potential to instantly drain the account your income lives in. That conversation works against the bank's interest. So, it doesn't happen. What the Electronic Fund Transfer Act actually says, when debit card fraud occurs, the money leaves your account the moment the transaction posts. That's not a bank policy. That's simply how the system works. After you report the fraud, Federal law, specifically the Electronic Fund Transfer Act, gives your bank 10 business days to investigate the claim, not 10 calendar days, business days. Weekends don't count. Federal holidays don't count. If the investigation needs more time, the window extends to 45 calendar days, with one condition. The bank must provisionally restore your funds within that original 10 business day window while the investigation continues. But here's what most seniors never calculate. 10 business days is 2 full calendar weeks. If fraud hits on a Wednesday, provisional credit may not land until the following Wednesday at the earliest. And the bank has that entire legal window available to them. Your mortgage, your utility bill, your prescription auto payment, your supplemental insurance premium, none of them know or care about any of this. They process on their own schedule. When the balance isn't there, they bounce. And each returned item generates a fee from your bank, and often a separate fee from the creditor too. There's also a reporting window most seniors don't know exists. Report fraud within 2 days of discovering it, and your liability under federal law is capped at $50. Wait past 60 days from when the fraudulent transaction showed up on your statement, and your liability expands to cover everything the criminal took. That 60-day clock starts from the date your statement was sent, not the date you opened it. What this actually looks like when it happens. A 67-year-old retiree receives her Social Security deposit on the 3rd of the month, $2,711 total. She uses her debit card for groceries, fuel, and a handful of monthly subscriptions. On the night of the 4th, a criminal deploys her card number, captured weeks earlier by a skimmer at a gas station she visits routinely, and runs 4 transactions totaling $1,620 at retail locations in another state. The transactions complete in minutes. She wakes up on the 5th to a balance of $451. She calls the bank right away and reports the fraud. An investigation opens. 10 business days. Her mortgage payment process is on the 10th. Returned. Her utility payment process is on the 12th. Returned. Her supplemental insurance premium process is on the 15th. Returned. Each returned item triggers a bank fee of $34 to $35, and each creditor adds its own return payment charge on top. By the time the investigation closes and her funds are restored, she's absorbed more than $100 in bank fees, more than $75 in creditor charges, a returned payment mark in her insurance file, and nearly 2 weeks of individual phone calls to every creditor explaining a situation that was never her fault. The fraud itself was painful. The structural collapse that followed is what actually consumed her. Credit card versus debit card. The legal difference nobody explains. Here's the comparison your bank will never put in front of you. When fraud hits a debit card, the money leaves your account the instant the transaction happens. Protection kicks in afterward. When fraud hits a credit card, the charge never touches your money at all. It sits as a disputed item on a credit line that belongs to the issuer, not your bank account. You owe nothing on it while it's disputed. Every major card issuer reverses it immediately upon report. Your checking account is never even in the picture. One payment method moves your money before anyone asks a single question. The other never moves your money at all. That's the entire conversation your bank isn't having with you. Federal law versus your bank's voluntary promise. Most banks market a zero liability debit card policy. It sounds like the same protection a credit card offers. It isn't. The Fair Credit Billing Act protection on a credit card is federal legislation passed by Congress. No bank can alter it without an act of Congress. Your bank's zero liability debit card policy, on the other hand, is a voluntary internal commitment the institution created and can change at its own discretion. Banks have narrowed and conditioned these voluntary policies before, and they'll do it again once fraud losses reach a level that makes revision financially worthwhile. Anyone relying on a voluntary bank policy for protection is one internal memo away from a very different reality than the one they think they're in. If you don't know what your bank is legally required to do when a fraud claim is filed on your account, or what actually separates a federal protection from a voluntary bank policy, that gap is one transaction away from becoming expensive. The Senior Money Defense Playbook covers the bank account rules, the freeze prevention steps, and the trusted contact setup that protect your account before a problem ever starts. The link's in the description below, or scan the QR code on screen right now to grab your copy directly. The two-account system, income account and spending account. Now, let me walk you through the setup that permanently walls off your retirement income from every gas pump, restaurant terminal, and online checkout in the country. It takes one phone call to put in place, and it's been standard practice among financially savvy people for a long time, while most of the country got handed a debit card and wished good luck. It's called account separation. Two accounts, two distinct jobs, a hard wall between the account where your income accumulates and any account that ever faces a commercial transaction. Account 1, your income account. Every deposit with your name on it lands here. Social Security, pension distributions, investment income, retirement account withdrawals. Everything flows in and stays in this account alone. No debit card attached to this account ever enters a merchant terminal. No card number from this account is ever stored at an online retailer. No gas pump, restaurant reader, or checkout system ever sees this card number in a transaction. This is where your money lives. Every automatic payment you have is anchored here too. Your mortgage, utilities, insurance premiums, Medicare supplement payment, prescription autofills. Everything running on a fixed schedule draws from this account. The card tied to it stays in a drawer. It's there if you ever specifically need it, but it doesn't go in your wallet for daily use, and it never touches a merchant system. Account 2, your spending account. This carries its own separate debit card. You fund it periodically from your income account, $200 or $300 at a time, enough to cover a week's routine purchases. Groceries, fuel, coffee, whatever you buy in person regularly. If a skimmer captures this card's number, the criminal gets access to whatever small balance sits in that account, $200 or less. Not your monthly Social Security income. Not the account your automatic payments pull from. Not $2,711 disappearing in the middle of the night while you slept. This is the only card that belongs in your wallet for daily use. The income account card stays home. Even better than a spending account debit card is replacing it with a credit card, used the same way. Not to carry a balance, not to pay a dime of interest, just for every routine purchase, paid off in full on the due date each month. Every transaction on that card is protected under the Fair Credit Billing Act, federal law, permanent, zero liability for fraud, immediate reversal on report, and your income account, the one your mortgage servicer, utility company, and insurance carrier all draw from automatically. Never touches a merchant system in your day-to-day life. If you'd rather not use a credit card, the two-account debit setup accomplishes the same separation. The principle is identical either way. Put a hard barrier between where your income accumulates and anywhere it faces the commercial world. The 4 situations where debit is the right tool. The goal here isn't to eliminate debit cards entirely. It's to use them only where they actually serve you well. There are 4 specific situations where a debit card is still the correct tool. Situation 1. ATM withdrawals at your own bank's machines. You're pulling your own cash directly, not transmitting your card number to a merchant terminal. Before inserting your card, take 2 seconds to check the card slot. A legitimate reader sits solidly integrated into the machine. If anything shifts or feels loose, use a different machine or go inside. Shield your keypad with your hand when you enter your PIN. Situation 2. Small local businesses that don't accept credit cards. Pay only what that transaction requires and use your spending account card, never anything connected to your income account. Situation 3. Government agencies and utility providers charging a credit card convenience fee of 2.5% to 3%. On a $200 payment, a 3% fee costs you $6. If that same payment goes through free on a debit card, use the spending account card. Situation 4. Businesses offering a cash or debit discount. Same rule, spending account card only, never the income account card. Those 4 situations, and nothing else, justify reaching for a debit card. Every other transaction belongs on your credit card or your spending account debit card. The one rule with no exceptions. One rule applies no matter what else you decide, and it has 0 exceptions. Never use a debit card at a gas station pump. Walk inside and pay at the register, or use a credit card at the pump. Fuel pump skimmers account for a disproportionate share of all debit card fraud, the FTC documents each year. The pumps sit unattended for long stretches, and modern skimming hardware has shrunk to the point it fits inside the pump housing itself. Completely invisible from the outside. You can't see it. You can't detect it. You can't know it's there. Using a credit card at the pump costs you nothing extra and permanently removes the single riskiest skimming environment in your daily routine from touching your income account. One habit change, every gas station, every time, no exceptions. 4 security practices for every debit card you keep active. The 2-account system handles the structural risk. These 4 practices handle everything else. All 4 take effect immediately, and none of them cost a thing. Practice 1. Real-time transaction alerts. Turn these on for every account you hold, triggered on every single transaction the moment it posts. Not a daily summary, not a weekly digest. One notification the instant any charge hits, regardless of the amount. When an unauthorized transaction appears, you'll know within seconds, not days. Not whenever your next statement shows up. Seconds. That timing is the difference between catching fraud on a $47 test charge before it escalates and discovering $1,620 gone at 9 a.m. after 6 hours of damage. Call your bank today and confirm real-time alerts are active. Ask specifically whether they trigger on every transaction or only above a certain threshold. Many institutions default to a minimum dollar amount, which means small test charges slip through undetected. Ask for alerts on everything, no minimum. If they're not already active, ask your bank to turn them on before you hang up. This one step turns your fraud discovery timeline from days into seconds. Practice 2. Reduce your daily spending limit. Most institutions default to a $500 to $1,000 daily debit spending limit. That default exists for the bank's convenience, not your protection. Ask them to lower it to $200 or $300 on your spending account card. This doesn't stop you from making larger planned purchases. Those can still be authorized individually with a quick call beforehand. What it does mean is that a criminal holding your card number can't run $900 across 3 states between midnight and sunrise. It shrinks the window they have to do damage before alerts fire and the card gets frozen. A $200 daily limit turns a potential overnight disaster into a manageable inconvenience. Practice 3. Never let online retailers store your debit card number. Decline that option every time, even though most retailers offer it for faster checkout. When a retailer stores your card and their database gets breached later, your debit number is part of what criminals collect, and your checking account is the one that gets hit. Enter the number manually each time instead. Some banks also offer virtual card numbers, temporary numbers generated for a single transaction that can't be reused. Ask your bank if that's available to you. And if you already have a debit number saved somewhere online, log in this week and remove it. Most retailers have a payment settings or wallet section, where stored cards can be deleted in under 2 minutes. Practice 4. Review your account every 3 to 4 days. The 60-day reporting window under the Electronic Fund Transfer Act isn't as generous as it sounds once you understand how the clock actually runs. It starts from the date your statement was sent, not the date you opened it or noticed a problem. Discover fraud in week 7, and you're already in the zone where your liability under federal law has expanded, and the bank has no obligation to investigate a claim reported past that window. So, spend 3 minutes every 3 to 4 days scanning your recent transactions in your banking app. Look for anything unfamiliar, a merchant name you don't recognize, an amount that doesn't match what you remember spending, a transaction from somewhere you weren't. Any of that means an immediate call the same day, not the same week. Fraud often starts with a small test transaction, a few dollars, to confirm a card is active before a bigger one follows. Catch the small one, and you stop the large one. Now, I want to pause here, because if you've stayed through the legal difference between a federal protection and a voluntary bank policy, through exactly how the damage unfolds after fraud, and through the full 2-account structure that keeps it from ever reaching your income, you're still here because you understand this isn't theoretical. It's one phone call and a few habits away from being handled. If you're not subscribed yet, do it now and turn on the bell. This channel covers the bank account rules, the Social Security protections, the Medicare fixes, and the tax rules affecting senior income, in plain language before they cost you. Hit subscribe, and let's get into the exact phone call. The exact phone call to set this up today. Here's exactly how the conversation goes, so there's no reason to put this off. Call the customer service number on the back of your existing debit card, or visit your branch in person if you'd rather talk face-to-face. Either works. Most banks handle this in one call or one visit, in under 15 minutes. Say this: I want to open a second checking account linked to my existing one with its own separate debit card. That's your opening line. The bank handles the rest. From there, ask them to set up automatic periodic transfers from your primary account into the new spending account, weekly or bi-weekly, in whatever amount covers your routine purchases. Once the spending account is open, go through your automatic payments and confirm every single one draws from your primary income account, not the new spending account. Mortgage servicer, utility providers, insurance carriers, Medicare supplement premiums, prescription autofills. Every recurring payment stays anchored to the income account. The spending account card is for daily purchases only. Nothing scheduled should ever pull from it. While you have the bank on the line, ask for 3 more things before you hang up. Request real-time transaction alerts on both accounts, triggered on every transaction with no minimum threshold. Request a daily spending limit reduction on the spending account card down to $200 or $300. And request written confirmation of your exact liability for unauthorized transactions on each account. An email or printed summary works fine. You want that on file so you know exactly where you stand before any fraud happens, not after. That's the whole setup. One call, roughly 15 minutes. From that point on, the account where your Social Security deposit lands every month is permanently walled off from every fuel pump, every restaurant reader, and every online checkout in existence. A criminal who breaches the spending account finds $200 or less. A criminal who never reaches the income account finds nothing. Let me bring this all together in one clear list. Every item on it is free, every item is available today, and every item either eliminates a risk permanently or shrinks it down to manageable before it ever becomes a crisis. Today, before anything else, call the number on the back of your debit card and open a second checking account with its own separate card. Say the line, I want to open a second checking account linked to my existing one with its own separate debit card. Ask for automatic periodic transfers into the spending account. Request real-time transaction alerts on both accounts with no minimum threshold. Request a daily spending limit reduction to $200 or $300 on the spending account card. Ask for written confirmation of your fraud liability on each account. If you're heading to a gas station today, go inside to pay at the register or use a credit card at the pump. Not next week, today. That one change removes the single highest risk skimming environment from ever touching your income account before you even start the car. This week, review every automatic payment and confirm it draws from your income account, not the spending account. Mortgage, utilities, insurance, Medicare premiums, prescriptions, every recurring payment anchored to the account your income lands in. Log into every online retailer where you have a debit card stored and remove it from your saved payment methods. Most have a payment settings section where stored cards delete in under 2 minutes. Ongoing, review your account every 3 to 4 days, 3 minutes at a time. Look for anything unfamiliar. Small, unrecognized charges often come before larger ones. Catching a $4 test transaction stops the $1,600 that follows. If a transaction you didn't make shows up, call the bank the same day, not the same week. The 60-day reporting window under the Electronic Fund Transfer Act starts from your statement date, not from when you notice the problem. Every day you wait inside that window is a day closer to your protection narrowing. Your debit card operates under different, weaker federal protections than your credit card. During a fraud investigation, your money can stay out of reach for up to 10 business days while your automatic payments keep processing and fees pile up. Your bank's zero liability debit policy is an internal document, not a federal statute, and it can be changed without notifying you. The two-account system takes one phone call and permanently removes your primary income account from the reach of any merchant terminal. 4 situations justify a debit card: your own bank's ATM, businesses that don't take credit cards, government payments carrying a credit card convenience fee, and cash discount situations. Those 4 and nothing else. Everything else belongs on your credit card or your spending account debit card, and gas station pumps get their own category. Never, under any circumstances, from any account. I want to speak directly to the seniors watching who recognized themselves in that scenario earlier. The mortgage that got returned, the insurance notation, the 2 weeks of phone calls. If that felt familiar, or if you realized while watching that your income account and your spending card are actually the same card right now, what I just walked you through is one phone call away from being permanently fixed. But the debit card risk is just one of 7 documented rules quietly working against senior finances in 2026. There's the joint account that legally hands your savings to a creditor the moment your child's name goes on it. The FDIC coverage gap most seniors have never checked. The trusted contact setup that prevents account freezes before they start. The provisional income formula determining whether the IRS is taxing Social Security it was never supposed to tax. The Medicare surcharge still running on income you stopped earning 2 years ago. And the Social Security earnings, record error, quietly shrinking your monthly check with no notification sent. I put all 7 together in the Senior Money Defense Playbook. Every rule explained plainly, every government form named, every phone number listed, every action step spelled out, so you know exactly what to do and exactly when to do it. If even one chapter puts 1 month of a missed correction back in your account, or prevents one fraud scenario from ever reaching your income, the guide has paid for itself many times over. The link is in the description below and in the channel bio, or scan the QR code on screen right now to grab your copy directly. It's called the Senior Money Defense Playbook. Subscribe and turn on the notification bell, and share this with one person in your household who's still running their monthly income and their daily spending through the same card. That one conversation might spare them 2 weeks of calls to creditors over fraud that started with a single card swipe at a single gas pump. I'll see you in the next one.